F. Calculate degree of operating leverage, DOL, and degree of financial leverage, DFL. Degree of operating leverage, DOL, measures the sensitivity of operating income to changes in sales. It is calculated as contribution margin divided by operating income, or as percentage change in operating income divided by percentage change in sales. A higher DOL indicates greater earnings volatility from small sales fluctuations. Degree of financial leverage, DFL, measures the sensitivity of net income or earnings per share to changes in operating income. It is calculated as operating income divided by operating income minus interest expense. A higher DFL indicates greater financial risk due to fixed interest commitments. These measures help assess risk exposure. Companies with high combined leverage face amplified effects, both positive and negative, from changes in sales, influencing strategic pricing, expansion, and financing decisions. G. Evaluate the effect of debt versus equity changes on capital structure and solvency. Capital structure reflects the proportion of debt and equity used to finance assets. Increasing debt raises leverage ratios such as debt to equity and debt to assets, potentially enhancing returns but increasing solvency risk due to fixed repayment obligations. Leverage ratios quantify financial risk exposure. For example, the debt-to-equity ratio, total debt divided by shareholders' equity, shows how much financing comes from creditors relative to owners. A higher ratio indicates greater financial risk and reduced solvency margin. Changes in financing decisions alter long-term stability. Issuing more equity lowers leverage ratios and improves solvency but may dilute ownership. Increasing debt enhances return potential but raises default risk and interest burden, affecting creditworthiness and financial flexibility. H. Calculate and interpret the financial leverage ratio, equity multiplier. The financial leverage ratio, also known as the equity multiplier, is calculated as total assets divided by shareholders' equity. It indicates how many dollars of assets are supported by each dollar of equity. A higher multiplier signals greater use of debt financing. Changes in capital structure directly affect the equity multiplier. Increasing debt while holding assets constant reduces equity proportion, increasing the multiplier. Conversely, issuing equity lowers the ratio and reduces financial leverage. The equity multiplier links to return on equity (ROE) analysis. Through the DuPont framework, higher leverage can increase ROE when returns exceed borrowing costs. However, excessive leverage raises solvency risk, increasing the probability of financial distress during downturns. 1. Calculate and interpret debt to equity, long-term debt to equity, and debt to total assets. The debt to equity ratio measures the proportion of total debt relative to shareholders' equity. It is calculated as total debt divided by shareholders' equity and indicates the degree to which a company finances operations through borrowing versus owner investment. A higher ratio suggests greater financial leverage and higher financial risk. The long-term debt-to-equity ratio focuses specifically on long-term obligations. It is calculated as long-term debt divided by shareholders' equity and provides insight into long-term solvency risk by excluding short-term liabilities from analysis. The debt-to-total assets ratio measures the percentage of assets financed by debt. Calculated as total debt divided by total assets, it indicates the proportion of creditor financing. Higher ratios imply greater vulnerability during downturns due to fixed repayment obligations. J. Define, calculate, and interpret fixed charge coverage, interest coverage, and cash flow to fixed charges. The interest coverage ratio, times interest earned, measures a firm's ability to meet interest payments. It is calculated as earnings before interest and taxes, EBIT, divided by interest expense. Higher values indicate greater protection for creditors and lower default risk. The fixed charge coverage ratio expands the analysis beyond interest expense. It includes lease payments and other fixed financing costs, typically calculated as EBIT plus fixed charges, divided by fixed charges. This provides a broader view of financial commitment coverage. Cash flow to fixed charges emphasizes liquidity-based solvency. It compares operating cash flow to total fixed charges, highlighting whether actual cash generation, not accounting income, can support required payments. This measure is particularly important during volatile earnings periods. K. Discuss how capital structure decisions affect the risk profile of a company. Capital structure determines the balance between debt and equity financing. Increasing debt raises financial leverage, potentially enhancing return on equity when operating performance is strong, but it also increases mandatory interest payments and default risk. Higher leverage increases earnings volatility and financial risk. During economic downturns, fixed interest and principal obligations can strain cash flows, elevate bankruptcy risk, and reduce financial flexibility. That a conservative capital structure lowers financial risk but may reduce return potential. Companies must balance risk and return objectives, industry conditions, and access to capital markets when determining optimal leverage levels to maintain long-term solvency and shareholder value.